All right, we are live. Welcome in here, everybody, to the Prospero.ai stock market live streams on this green day across the board for the markets. Good to see it after the CPI came out a little bit cooler this morning. It was able to calm the market's biggest fears, and we are seeing green across the board. Really good test opening up green today, going back down, testing if we were going to head lower and finally regaining the green strength. So once George gets in here, we'll cover all of the latest moves we're seeing in the market today. In Prospero, we're still seeing low net option sentiment for the SPY and QQQ. So can we see this green uh, move in the market continue, or is this just a one-day event? We will get into all of those details. We obviously still have lagging concerns. Canada came out with a response to tariffs, charging 20 or reinstating 25% tariffs on $20 billion worth of USA goods. So those concerns are not going away in the markets, and these tariff flare ups could continue from here on. We have Taiwan Semi approaching AMD, Nvidia, and Broadcom to take over Intel's foundry businesses, which sent Intel shares up this morning. Let's see how it's doing now that the market is green today. I feel like we've seen a lot of stories like this around Intel over the past year as the stock has struggled, but none of them have been able to stick. So Intel right now is up 4%, just over $20 per share. But they were up as much as I think 12% this morning, 13% at one point. So it's kind of faded, and the stock has just bounced along the bottom for a while now. So is this finally the story that's going to send their shares higher? Or are investors getting tired of hearing these stories? And what would it mean for Taiwan Semi, AMD, Nvidia, Broadcom if they were to take over these businesses? We have a story about Walmart and their method of going about handling the tariffs impact on their business. They are speaking with China's Ministry of Commerce. So we'll get into what it means for them and how they are trying to handle the impact of the tariffs price raises for them. I came across a new thing today that you guys might want to hear. I see we have over 40 people in here already. So thank you all for tuning in so quickly. Like the video if you're excited about these topics, but it's called the VIX Rule of 16. And although you hear the VIX being thrown out a lot, and we all know it relates to volatility, this really puts concrete specifics on what the VIX means. So it'll be interesting to find out. Stick around for that. I'm surprised I'd never heard of it before today. If you have, let us know in the comments. Then we have some data from the Prime Book data surrounding the total liquidations that have happened and the amount of hedge fund selling we're seeing in the current market. Um, Surpasses anything in history while this data has been tracked. So it's pretty crazy. And obviously, we've seen the SPY and QQQ net option sentiments in Prospero hang out very low. SPY has been at zero flatline for some time now. It'll be a good time to check that out. So SPY is still at zero. And yes, zero flatline for the entire chart. QQQ. QQQ is at 24. Good to see that it's up off its lows as the market's rallying a bit. But this liquidation data and this selling from hedge funds kind of goes to point out why we're seeing such bearish metrics in the Prospero app. Then we have two more stories that we're going to get into today before the end of the stream with the model portfolio update, which hopefully will be a little bit more bullish than it's been, although a lot can happen in the last hour of the markets as we've seen so far in 2025. So who knows? We'll have to stay tuned. But we have Spotify paying over $10 billion in royalties in 2024. I think they're going on some kind of marketing campaign now since they're starting to get a lot of pressure about the amount that they pay to artists. I think some artists are pretty upset with the total payouts. I've heard some crazy low numbers for even really big musicians. So it looks like Spotify is trying to maybe get ahead of the headline risk, like George has talked about before, when businesses are brought up in the news for the wrong reasons. And then the last story we have today is about an estimated $124 trillion of capital that will change hands between now and 2048. So 23 years. It will be the greatest generational wealth transfer in history. So how can you, all 72 of you in here right now, take advantage of this transfer of wealth? Can't wait to hear what George has to say about that. So those are all the topics. As always, let me tell you all, if you have any questions, stock specific, market, broader market related, macro, micro, let us know in the comments. We are happy to answer all of your comments. Let me check, as we're waiting in here for George, let me check, see if there's any noteworthy moves we're seeing in the market today. Let's see. So obviously the Mag 7 has been hey George, welcome to the stream. The Mag 7 has been such a topic of discussion recently amongst investors with its underperformance. It looks like they are up across the board today with one exception. Let me just check Nvidia's. Yep, Nvidia's up as well. So Apple is the only Mag 7 stock down today. Maybe that's noteworthy for all of us, especially as the market is ripping higher today after the CPI we got this morning. The QQQ is up 1.3% right now. The SPY is up 0.8%, and the Dow is up just barely 0.1% on the day, so almost near the flat line. The Russell is up 0.6%. So all green. George, we got a little bit of a cool CPI reading this morning. It came in at 0.2% for the month of February. 2.8% for the annual reading when 2.9% was expected. It's the lowest CPI report we've got in some time now. Obviously, we're seeing the markets react positively. How are you feeling, though, after we got this report?
Good. First off, how's the camera looking today? I think I finally got the settings figured out.
Yeah, it looks good. Nice and crisp.
Excellent. I didn't know about the light because I can't see my screen. But yeah, I think, we kind of needed that to come in kind of a little cool. I think that was the optimal situation because too cool, and I think people would be worried about the economy slowing down. Now we kind of have some people worried about growth and some people worried about inflation at the same time. And it's been a long, long time since that's been the truth. So I definitely think this is more of a reprieve. We're still more short than long. We're kind of pursuing a new strategy that's, I think, worked a little better, a little more stable this week, requires us to make less moves. We're going to write about that in our newsletter. But yeah, in any market, you can get the hang of it. And I think much like in some markets last year, I don't think we're going to be taking as many big swings, so not having as many big wins. But I think we have a more stable way to manage this as we've, kind of analyzed the data more.
So a lot of what I was reading and listening was that the market was positioned in a way where it should bounce very soon heading into this report, just because how oversold it was on a lot of the metrics. Do you think that's all we're seeing today and we're just seeing that kind of relief bounce? Or do you think this is kind of setting up for a more sustainable rally? Or is it too soon to know which one it will be?
Well, we were due for a relief bounce, and this definitely is that. But we were only going to get a relief bounce. I think the market desperately needed some good news, and it got some today. So I think there needed to be a catalyst for that relief bounce, because without the catalyst, it clearly wasn't working. But I don't think there's more economic news coming this week. Obviously, I don't think it's going to keep going up unless the news continues to be good. If the news continues to be good, yeah, I think we could get a bit of a nice week, a nice rebound week after a few horrible weeks. But I think if there's bad news or even just news, if it just comes in as expected, I think we might be going the other way. Again, that there isn't a lot of support in the market. SPY net option sentiment is still at zero. QQQ has been pretty low, although it got a bit of a recovery today. We just are not in a healthy place for the market.
So Jonathan is asking about Tesla, one of the stocks that got hit the hardest in this pullback of the markets. He said Tesla net option sentiment is currently at 99 and technicals at 94. What would you need to see in order to get back into Tesla? Would you need to see net option sentiment at 100 for a few days?
I already got back in it a few days ago in my trading portfolio. In that portfolio, I saw enough. In my high conviction portfolio, it's just not happening. It's the issue is that there's boycotts of the product from Elon Musk, whose popularity is really going down. And I don't really make stock forecasts off popularity of a person, especially if that popularity is going down. Could it be a value right now? Do I think some people see value? Yes. But next month we could get reports of sales declining even more for Teslas internationally. And I think there's so many other risks in the market. If we weren't dealing with a serious, bear run overall right now, I'd be singing a different tune and I'd be saying, okay, maybe it's worth the risk. There's a lot of upside here with where the signals are pointing. But, I think the signals are pointing up because some institutions see value. And I just think I've seen too much volatility. Like, it is having another good day. Like, I'm thinking about it a little bit, but in the end, it just feels too risky with, kind of the decline in sales that we've already seen.
So I think, if I'm not mistaken, a lot of people's fears around these tariffs is that they're going to drive inflation further. And since we got a cool report, do you think that main driver of this negative move in the market is now less of a concern, or do you think the effects of the tariffs haven't really set in yet, and people still expect that could happen? How do you
Yeah,
lay
I
out
mean,
that
we've
now?
barely even gotten the tariffs. And this week is really, I think, the first week we're seeing any retaliatory tariffs, which that, could kind of balloon the situation, even more, especially if there's then retaliatory tariffs for us. But yeah, I mean, regardless, it takes a bit, it takes at least a month of prices for it to impact. And we haven't really even seen a month of live tariffs yet. There's been a lot of there's going to be tariffs, there's not. Kind of at the beginning of this month, we definitely saw, I think this is the first one where we're going to see tariffs and we're sticking with tariffs. So I think it's probably not until the next reading that we even can begin to understand the impact. But I think everybody's going to be watching that very closely. Yeah.
And I'm pretty sure Canada just had a change over of power from Trudeau to someone new, and it seems like they're coming in hot and trying to set the tone since they just took over. And I saw the story about how Canada is responding to the tariffs that were just placed on them with 25% tariffs on more than $20 billion of U.S. goods. And this is after they already had 25% on 30 billion of goods. And I saw a headline about the EU responding to tariffs. But do you think that, now we're several weeks into these tariff headlines day after day, do you think they're going to lose some of their effect after, people get used to seeing these headlines? Or do you think they're actually structurally concerning, so it doesn't really matter if people get used to them?
No, I think they're structurally concerning. And I think what we saw for a bit was the market maybe saying that it's all talk and they're not going to happen. Now that we've actually seen them, we have to really see what the impact is. And I think that's what the hesitation is, or if it's going to escalate. I think that's the biggest fear, because Trump has said when he sees, kind of retaliatory tariffs, he'll raise them on our end that much more. So, that's, I think, the real fear. If you're talking about where all of the fear is around the tariffs in the market, it's very much attached to the fact that nobody really even knows how to model how high they can get. And I think the other thing is there's not really a good understanding of what we get on the other side and when we get it, right? I think there's kind of a decent amount of saying that we have a trade imbalance and we need to fix that, and they'll create tax revenue and that'll pay off all the bills. But I don't really necessarily know how much that's really going to help us or be a real thing. Because even if the country is making more money, but that's essentially coming out of the pockets of everyone as people like tariff more, and it makes things like businesses more difficult. It makes it more difficult, like it makes profits more difficult for those businesses. That can essentially be people lose their jobs. That can essentially negate the tax revenue that we're getting in from tariffs. So, I haven't seen a really cohesive plan. I mean, there might be one, but I haven't seen it that says, definitively these tariffs are going in a long term going to, add more to our economy than they take out. I mean, especially when you take into account what we're talking about with the government cuts too, right? That's money coming out of the economy. Right? Money's already coming out of the economy. Things get more expensive. People lose jobs. Businesses close because it becomes more expensive to run the businesses as a result of the tariffs. That could, in the end up being more negative than positive. And I don't see a lot of analysis around that being published. And if there's no analysis around that, it makes me skeptical if there's real numbers to support it.
So comment from Jot Wanik in our chat. Where would you park cash, ETF recommendations, or all assets until the global tariff scenario becomes clearer, hopefully?
I mean, I think the best thing you could do is be net short. Whether that be, I always recommend SQQQ or SCC, or you can do a 1X to make sure that it's easier to calculate, what being net short is. But I think it's way easier to be net short in the right spots than be net short in the right spots than go to cash, right? But if that doesn't feel in your wheelhouse, I always kind of say, and we say it here, Buffett's in cash. If Buffett's in cash, you can never, largest cash position ever. It's never a bad idea to go to cash. We just advocate for short positions.
What about the Schwab dividend ETF? Do you think that is maybe what Jot, if he's looking to hold steady his cash, would that be a safe thing for him to do or something like that?
I mean, that's when you get into this thing where it's just better to pull it out, right? Because the Schwab dividend, if the market goes down, that is going to go down, and the dividends are going to pad that a little, but they're not going to pad it that much. That's why, you could go short some ETFs and then Schwab dividend long, right? To own something, but I do think if the market's ultimately going to go down, whatever you own long, if you're just pure long, it's not going to work out well for you.
Mm-hmm. So, as we've talked so much about tariffs, I saw this headline about China. Walmart in China. So Walmart was going to a lot of their suppliers and asking them if they could get a better price on goods, since to try and offset these tariff impacts that they're going to feel. And China was not happy about that. And the China Minister of Commerce was talking to Walmart and kind of pressuring them to lay off on this request. Do you think? I would assume Walmart's maybe one of the highest importer of goods to sell. Do you think if you just look at a list, if we pulled up a list of the companies that have the highest imports, they're going to be the ones that struggle over the next, the rest of the 2025, as long as these tariffs are going on?
Yeah. And I mean, I would say, one of the reasons we talked about the downside, one of the reasons that, tariffs can be very good is it puts more money in your economy for domestic produced goods. But the problem is manufacturing has largely left. And, that's an area that we can say, again, where it's just okay, where are the numbers? Or are we just talking in hypotheticals, right? In hypotheticals, right, we could build a better manufacturing industry. We don't have it. It is better to have existing manufacturing that you think will grow domestically around tariffs, but a lot of there's been a huge globalization effort. Both parties have really made a lot of effort to acquire goods to globalize, expand internationally, import goods. There's been a trade imbalance for a long time, but it's just like thinking about the things that Walmart sells, right? What percentage do you think is made in America? I would say very few, if any, right? And so that's a big difference. There are some places that might say, oh, I'll just buy domestic, and it's like a slight increase. But even if Walmart has options, it's going to be a huge increase relative to China, and that doesn't support their business model. So yeah, they got to try to stab at this however they can. But yeah, it's in trouble.
And we covered the crazy move that Walmart stock had made before this most recent pullback. They're now 20% off their highs. We'll see what happens to them and a lot of other big retail companies throughout this year. I feel like retail, car companies, like anything industrial, you think those are the ones that are in the line of fire the most?
Yeah, I mean, I think retail, especially like car companies, it really depends. Like, actually, I mean, I don't know the numbers, but if you're thinking of like American car companies that all of a sudden might have a better relative price, an American car company might not be a bad move, especially one that doesn't get bought. Like, I don't know off the top of my head the extent that, Ford or GM or any of them sell overseas, but I don't think they have a tremendous amount of their business. So a car company could actually really help. That's kind of the reverse of what we're talking about with Walmart, where it's just like the products that they sell, I don't really think there's domestic substitutes that are that easy, because that kind of manufacturing, has largely left the US. So yeah, it's one of those things that I would be, the problem is, and what I kind of keep coming back to it here, is it doesn't seem to be like a cohesive long-term plan, right? Like, what makes more sense with tariffs, right, is if you start your administration, you build up manufacturing, right? You subsidize the building of more manufacturing in your country, figure out how to maybe subsidize labor a little bit to then make a competitive product and support the industry, with the idea being, that trade imbalance might long-term help your economy by just putting more money in versus having more escape to foreign countries. But that's what I'm saying. I don't like, without the proper manufacturing infrastructure in this country, I don't really know the extent that tariffs will really help. But I think cars are an exception, where there are still car companies that don't export a lot, to my knowledge. And if there were tariffs, they're really going to do better on relative pricing here and might sell a lot more cars. So that's one thing where manufacturing hasn't completely left this country. But we always talk about the government and socialism that they do pay for. Obviously, they bailed out the car companies, right? And those companies might have been non-viable had not been for that bailout, right? So that could have been another manufacturing that died out. It only did because of government intervention before. So that's what I'm saying. Sometimes it seems like we pick and choose, but to me, one of the reasons we're seeing this value evaporate from the market is because of the problem we're talking about. Because I just don't see how U.S. manufacturing is going to pick up the slack and keep more money in this economy if that infrastructure doesn't exist. You still there, Stephen? I think I lost you. I don't know if that's me.
Hello, am I back?
Oh, you're back. Yeah.
All right, wait, let me see if I could switch my audio back to my... Okay, I think you should still have me, right?
Yeah, I can hear you.
Okay, sorry about that. So I wanted to bring up this VIX rule of 16 that I saw, because I'm sure a lot of our viewers have heard a lot about it recently, since the market's been so volatile. I've always known, and I've heard people talk about the VIX, the higher it is, the more volatility there is, but I've never heard it. I've never heard this rule and how crisp it is, so the VIX rule of 16 indicates that when the VIX is at 16 on a 30-day forward basis, there's a 1% daily move expected across the markets. And going from there, if VIX is 32, so double, a 2% daily move average is expected. 24, 1.5%. So I thought that might be helpful to say and really put a clear number on it for people who have probably heard so much about the VIX recently. Maybe that'll help people out.
Yeah, I mean, I think it's one of those. I think it's one of those things that can be really, really helpful, especially with in conjunction with SPY, QQQ, then option sentiment. I think some people misunderstand it, but I think that's a really easy way to understand it. Volatility is always like, bi-directional, but there's some things like spikes in the VIX often mean a move down is coming. So there's nuances to it where, it's nice to have that kind of technical thing for you to know what you expect. But, unless you really understand what the VIX is, you should get to understand it, really map. You always have to create your own map. Don't just listen to what some people say. But I don't think that's a bad map to just say, hey, this could be a big move. Maybe I want to increase my risk management practices. I think the VIX moving, especially up, I think is a really good way to practice and kind of grok what you should do. But like anything, I would warn against hearing something secondhand about how to handle the VIX online, and then taking some action on it that is not mapped. And the best way to map it is take that rule, start to integrate, run small tests about how you evolve your practices with you, and that's how you can make it more of your own.
So obviously we've seen the SPY net option sentiment flatline at 0 for a while now, and maybe this data that I saw today is partially showing why. So the prime book data on global equities shows that hedge funds have sold their exposure at record paces, actually the fastest ever since they've been tracking this data. So faster than the 2018 correction, faster than the 2020 COVID crash, which I think is really surprising, and then even faster than the 2022 bear market. So I think that really puts into perspective how serious the move we're seeing now is in the markets.
Yeah, and I mean, I really think the first thing that we saw that was significant here is those options contracts not being renewed. And I think that might actually be a good timeline for us to watch and kind of look at like the way this bear run, the alarm was sounded on it. But yeah, it's shocking. I mean, we've really talked about a lot how severe this move could be. And it's just like, it's the same thing when we were first talking about those options contracts, where it's just like, there is nothing scarier than institutions not knowing or having confidence, what, the bottom of the market was, what are even like the factors to model to know, right? You can't model, say, tariffs like we're talking about without knowing how high they could get. If one country does it and we retaliate and they retaliate. So that's what's scary for modelers. And that's what ends up just pulling money out when they don't really know how to accurately model. This is like really off the map. And I also think the big difference, and you kind of see Wall Street reacting to it too. I think typically administrations in Wall Street are in, closer contact, and they kind of know and they consult on economic policy. And that's the old way. And maybe that wasn't the best way to give Wall Street the hints, but this way isn't necessarily better if they're just like, well, I don't know what's going on, so we're going to pull all our money out of the market, right? That's not necessarily a better alternative. Not that the last one was great, but yeah, I do think whether, Trump is just kind of talking to a smaller circle and not wider Wall Street or whatever, I do think that we're definitely seeing a different approach to everything here.
Mm-hmm. Is there any positive side to the fact that the pace at which they're pulling out money is the fastest ever? And I mean, almost certainly it has to either slow down or correct itself, or at some point they have to put that capital to work. Is there any kind of positive to take out from that kind of a piece of data?
not for anything bullish, right? I
Hmm.
think if you're looking for some kind of silver lining, um, you might say that maybe all this back and forth tariff stuff is going to end, because the administration sees that all the money is coming out, and they don't want to set the market into a total free fall. But yeah, I don't think you could really put a silver lining on institutions pulling all their money out, especially as retail stays in, because there's nothing worse. Those are the kinds of disjointed events that we hate, where retail is losing money and institutions are pulling out and making money on the way down. That just increases this wealth transfer that we've been seeing, the significant multi-generational wealth transfer. That's part of it. That when the market goes down, institutions are generally pulling out if they're smart, or shorting it, if they make even more money, and then they're getting it at discounts. They're the ones that are kind of deciding when it's over. And so yeah, these events I don't like to see.
So I was looking at our short-term bull list this morning in Prospero, and Intel was actually on it. So I was getting curious, why is Intel on it? And there was a story, and Intel was up over 13% this morning. It's kind of sold off throughout the day a bit. I think it's up about 5% now. But how Taiwan Semiconductor approached NVIDIA, AMD, and Broadcom. So they're forming like their own Avengers of the chip companies to take over in a joint venture Intel's Foundries division. What do you think of this? I mean, it seems like we've heard a lot of these stories about Intel and some activist positions or companies trying to get involved, but none of them have really come true. So, what do you think of this story?
It really feels like Intel is like throwing shit against the wall and seeing what sticks. So you don't really like that. I mean, at least it's not, when we talk about AMD just seems to be like not trying anything. And arguably, I don't know which approach is better. But yeah, I think that Intel is just like, we were in it and then we were out very quickly because it was a bad day. I think it's hard to depend on, like, to say, okay, I only see this company doing well if it gets more government handouts or it makes certain partnerships. I just think that's kind of a scary proposition.
Do you see like an end to the misery for this company though? I feel like there's been so many companies that have said they're interested, but nobody's really fully like taken it over, even parts of it.
No, I mean, we speculated on this before. We don't know. It's like probably an indictment of the management, right? Look at how far they've come. They had the market on chips cornered, and
Yeah.
now they're nothing, right? I mean, they're not nothing, but they're non-competitive.
I saw a wild stat. It was I don't know exactly what it was, but it was something like Intel was around a 10 PE in 2015, and Nvidia was like a 70. And they were saying like that's why you don't invest purely off PE ratio because the insane performance difference in 10 years of those two companies.
Yeah. Yeah, I mean, I think that's a great point. I mean, and yes, you don't want to be, too particular about PE.
The
Oh, dude,
Elgato has come back for
God, this thing
revenge.
is, I forgot how we solved this last time. I think I'm just going to refresh.
Okay. Well, let me, in the meantime, talk to our over 1,900 people that have tuned into the stream today. Thank you all. Hopefully, you've enjoyed the topics so far, the in-depth discussion on the macro and the current state of the markets. We have a couple more topics we're going to get into today before we do our full switch over at the end of the stream to do the model portfolio. Ooh, I will note that the Dow Jones has now gone slightly red on the day. So only 0.01%, but it is red. You know what? Maybe I should make myself bigger now that I'm the solo guy here. But so the markets are not green across the board. We'll have to keep an eye on that. It looks like the QQQ and the SPY have gone slightly lower. Not much of a move there in the past 30 minutes. If you've been in here watching and not watching the markets, but still 25 minutes left in the trading day, so we'll have to see how it closes out today. Thank you, Jonathan and Jotwinick for your comments. We love seeing comments in the stream. We are also trying to hit 3,000 subscribers on YouTube this year. So if you're watching on Twitter right now, you could head over to our YouTube channel and subscribe on there if you haven't done so yet. Or if you're just watching on YouTube and you're not subscribed, hit that subscribe button. We're getting closer to that mark. We are at 2,230 right now, so getting closer.
All right, we're back.
All right, back in business. We have two more topics to cover today. So Spotify, I think, George, they are taking an early approach to get out of the line of fire for the headline risk that you always talk about companies don't want to receive. I saw on a couple different stock market sources a story about how they paid over $10 billion in royalties to their musicians in 2024 and how 1,500 artists made over $1 million on their platform. And I think this comes as people are starting to question how much Spotify keeps and pays to their artists. So do you think that's a good strategy for them? Are they getting ahead of this problem?
Yeah. I mean, I think it's kind of funny when you kind of see these things in the headline risk. Yeah. I mean, it's been years and years that I've seen artists complaining about the split. And if you look at the split, it's horrible. I mean, it's one of those things where you really have to blame the record industry for like clinging to this old model that just became more and more disjointed until it finally got replaced. And artists were kind of just like, well, if we can monetize this at all, you guys suck. Yeah, I mean, artists make most of their money from touring these days. And that's kind of like shitty to realize, like, you know, I think people like Taylor Swift, like she like lives it. And she loves to write songs and perform. But I think some people just don't make much money because they don't want to be on tour all the time, or they don't just like touring that much, and are more just about wanting to make music in a studio. And now you can't really even do that anymore because of places like Spotify giving you like pennies on the dollar to stream. It's kind of shitty.
Yeah, so like you say, Taylor Swift and how she loves it, and I could add like one of my favorite artists, John Bellion. He took like a 6-year gap because of how bad the industry is and how he was getting robbed in his contract. So the way it's set up, it's kind of like robbing fans like me and other people of their favorite artists sometimes, which is really, really sad. But I see a comment from D. Curtin asking or mentioning TMHC. He's saying it's finally dropping. Was that a short for us?
Yeah, it's been like a frequent on the list. But yeah, I think we tried to time it once and didn't time it very well, but this time definitely looks better.
Mm-hmm.
I mean, it does not have that high of a downside or that low of an upside. But yeah, we've liked it's been on our short list of shorts for a while.
I can't wait to see the model portfolio today with everything happening in the market. So stick around, everyone. We just have one more story to get into, and that is how there is an estimated $124 trillion of wealth that will exchange hands between now and 2048, the greatest wealth transfer in history. I think our viewers are in the right spot to take advantage of it with the info we give out, but how can they maximize this opportunity if they are looking to take part in that 124 trillion?
Well, I think we're already seeing, and we're a part of it. All of us are a part of one of the things that is happening where retail investors, as part of this wealth transfer, when they're past money, they're taking a lot more active role in their portfolio than other generations, right? They're educating themselves. That's great. That's something that we're trying to capitalize on. But that's a double-edged sword, right? We always tell people, it's great to combine a good investment thesis with attention on social media, because those can be very powerful. And that's one of the things that we capitalize on well. But you have to be careful. Don't confuse a good investment that's getting accelerated by social media with something being accelerated by social media being a good investment. Those are two very different things, and it's important to make that distinction. But if you're prepared to do the former, if you're prepared to do good research, and have kind of like a tiebreaker and something that could accelerate your profits, verifying on social media, that could be a huge way to capitalize on this.
Well, George, it is that time. I see that the Dow Jones has now gone slightly red. The SPY and the QQQ are kind of slowly going down lower. So is no rally safe? We have to see the kind of moves you make on the other side in the Prospero
Yeah, I
Lab.
definitely think no rally is safe though.
All right.
All right.
Everybody stick with me. George will be right back with us, and we will make live moves in the Prospero model portfolio. So you'll want to hang around for that. Let's check now and see if anything has changed in the Prospero signals for the SPY and the QQQ. When we checked them before, they were both fairly low, but the QQQ was at least off of its lows. The SPY is still at zero as I'm looking right now. So that zero flat line remains steadfast for the SPY. And the QQQ is at 24. So I believe no changes from the beginning of the stream from when we checked earlier. So we will see what George decides to do in this market. Do you go a little bit more bullish with the green move we've had and the slightly, I guess, good data we received? I believe tomorrow we're getting PPI as well, so that's something to watch out for. Could be another market mover, maybe not as aggressive as today's CPI, but I know a lot of investors are going to be watching out for it. The Russell is now starting to go down a little bit more aggressively, approaching the flat line on the day, still slightly green. The QQQ just dipped below 1% up on the day. So maybe George was right. No rally is safe. Barbara asks, what was the other short ETF George mentions besides SQQQ? Does anybody remember off the top of their head? I'm not sure which ones he said before when we were talking about it. He'll be back here in a moment, so I'll read your comment for him. Unless any of our viewers remember. Let's see if any of the Mag 7 stocks have changed drastically since we started. Is Apple still the only one in the red? As of right now, it looks that way. Yep, all Mag 7 stocks are green on the day, except for Apple. Barbara, Jonathan commented SCC as the other one, but George is back in here so we can double check. George, Barbara was asking what short ETFs you mentioned early in the stream. SQQQ and what else? SEC?
And SCC, yeah.
Okay, yes. So
those
Jonathan
are my two preferred ones, just because like in any down scenario, I think tech and consumer discretionary, they're going to be hit the hardest. So it's a nice way to cover yourself in a more targeted way, especially SEC. I would say, because we have seen more tech rebounds, but SQQQ is going to provide you much more like downside protection. Okay. Okay, here we go.
George, is this your flu game today or you got allergies?
No, I think I'm sick.
So George is having his Jordan flu game on stream today, everyone. We need extra likes for George to help him get better by the end of the week.
Yeah, a college friend of mine died like 4 months ago, and I went to a celebration of life, and I think all of the interacting with people as well as the flight, like the quick turnaround on a cross country flight, I don't think either of those things really worked very much in my favor.
Well, I'm sorry to hear about that. He must have been pretty young, your age, right?
Yeah, a little younger.
That
I'm
stinks.
old for my grade, but actually he was in a grade below me. Yeah, it was really, really, really sad. when that kind of thing happened. This was the first one of my college friends to die. So I mean, it was nice. I did get to see like a lot of my friends from college that I hadn't seen in many years. So that part was good. Okay, but we're dragging ourselves through. What's SPY and QQQ net option sentiment?
SPY is remaining at 0 and QQQ is now 18.
Oh, I saw it at 17 earlier. All right, let's do this. Sharing the screen. Let's make sure we have that loaded. Let's get that all ready.
Important perspective to see large cap growth the best today, but still the worst on the 1 week. Lends itself to what I said above. That we need to see more, but we'll adjust a little. Energy appears to be the most consistent right now on the 1 week and 1 month, and the best, so we will look for a bull exposure there.
Oh, I hope I don't have the flu. I was hoping it was just a cold. Ugh.
Probably just a cold. Who gets the flu in spring? Or about to be spring?
All I know is I'm going to bed early tonight.
Vitamin C. That's the key.
Good idea. Coin, terrible random score. I think that's the first time I've ever seen coin that low on momentum score.
Seems as though the momentum in crypto is coming to a close for now.
$25.32. Yeah, that was a pretty good ratio coming into today. Time to get out of Aries. That's a huge move. Well, 78 momentum score is pretty high. Now it's still up there. Hall State. Maybe we'll go along that. This could be interesting. I think we added that. I think that's fine. Maybe ELV. Oh, well. It might be a nice pair. Maybe not. We got 4 there. Okay, so we're exiting more short. We want to balance more long. Yeah, I think. I want one more long. Maybe I shouldn't overthink this and do. Yeah, all right. We'll add another now. It's looking way stronger. All right.
Well, we finally got a positive catalyst. Do we need to swing bull or react in a more measured way?
All right. That's good. And then we're going to. Damn, we spoke too soon on TMHC. Is it a win right now?
Taylor Morrison Home down 1.57% on the day.
Oh, yeah, we got it. All right, we are going to do. Yeah, we can do this later. Yeah, we're going to do this later. All right, I think we're good to go.
Yes, thank you everyone for tuning in. We had a lot of viewers today, so thank you all. We will be back Monday, 11 a.m. to cover what's going on in the market. But until then, have a great rest of your week, everyone. See you then, George. Feel better.